everyone, welcome to Sundaram Mutual series Funds in Focus. In this series, we speak to our fund managers and ask them questions about the funds they are managing. Our fund in focus today is Sundaram Balanced Advantage Fund, and we have Bharath here with us. Welcome, Bharath. It's a pleasure to have you on this series. So, we have a few questions for you on the fund,
Sure.
and you can drop your questions in the comment section of this YouTube video. Bharath here is our head of research and our senior fund manager. So, are you ready, Bharath? Should we get started?
Sure.
Okay. So, the first question to you, Bharath. What are balanced advantage funds and why are they also called dynamic asset allocation funds?
Sure. So, thanks for this opportunity. Balanced advantage funds are, in a way, a category of hybrid funds which straddle themselves between equities and debt. And this is done based on a well-tested framework. So, the reason why they are called dynamic asset allocation funds is that they move or have the flexibility to move between equities and debt using a framework which has run through the past cycle successfully. So, in a way, it's something where it's a scientific way of straddling between equities and debt. And over the years, we've seen this asset class also bring in newer vehicles like REITs, InvITs, and some more to come in the years. So, from that perspective, I think BAF as a category is something where one should look at it as an asset allocation product which moves between equities and fixed income in a scientific fashion.
Okay. And this scientific fashion is predetermined by
So, in terms of framework, for example, at Sundaram, so we have a internal framework where we marry the market actions with fundamentals using a price earnings methodology. So, using this methodology, we figure out in terms of where the allocations need to be for this product in terms of equity. So, the framework essentially tries to figure out which are the points in market or what are the market actions which will lead to this product booking profits when markets are euphoric and entering at a time when there's panic in the market. So essentially it tries to take away the bias of a fund manager or the product manager and position the allocation based on how the fundamentals behave vis-a-vis the market actions. So when the PEs expand ahead of the fundamentals, so when we see the prices moving up ahead of the fundamentals, the product would force the fund manager to take profits out and reduce equity allocations. And likewise, when there is panic for various reasons in the market, it would force the fund manager to increase equity allocations when the fundamentals are intact. So, in a way, it takes out the biases and adjusts the equity allocation purely based on how the earnings are behaving. So, the crux of this is that market returns always mirror the earnings growth. So, if the earnings is reflected by way of P in a way that it mirrors the pessimism or optimism, the equity allocation has to shift accordingly. So we have a methodology which cuts the PE across cycles into various bands, and depending how the market valuations stack up, the equity allocations are managed technically.
So how often do you adjust the equity portion of the portfolio? And considering the current market volatility that we just had, how much exposure do you have to equities right now, and how has this changed in the last 1 year?
Yeah, so from a rebalancing perspective, we have a monthly rebalancing, and there's always a trade-off between how frequently one rebalances versus the expected outcome, because equities end of the day, most of the positioning is long-term. So there is a cost attached if one has to have a daily kind of a rebalancing done. So over here, what we do is that we look at how the valuations have stacked up for the broader market for the previous month, and plug it into the framework that we have, the PE-based framework. And depending on what allocation it throws up in terms of indicative allocation for the incoming period, the allocations are adjusted accordingly into the incoming month. So it is a process where clearly it looks into the market action of the previous month and use that as a input for looking at the equity allocations for the next month. And over here again, what we try to do is that we intendedly kept it monthly because we have earnings season as one large event for the investors of late, and this is something where the volatility has been quite high of late when you look at the way markets react, especially for the earnings print. But having this process ingrained in terms of monthly rebalancing, it forces the active fund manager to invest in the chosen set of stocks if the allocation were to move up as per the framework. So irrespective of whether there's an earnings surprise materializing or not, the price points are captured when these allocations are made using a rebalancing framework. And the second important point is over the last 9 months, we've seen a phase where markets have been moving up in the early part of FY22, and then we've had a fairly consolidating phase now. If you look at our allocations, we've been broadly ranging around the 45% handle till as early as March of this year, and incrementally we've been nudging up our equities towards the 50% mark as indicated by the framework. And the idea is that there's a time where we're starting to sense some bit of fear or panic setting in post the recent crisis, but at the same time we're still seeing the earnings print not reflecting any signs of weakness at this point of time. So from that perspective, the equity model is still forcing us to be invested and nudge up our equity exposure from a product perspective. And lastly, from stock selection, again, this product is all about managing risk end of the day. So the idea is to have positioning in stocks where we believe that the valuations play a large role when it comes to making a final choice. So there's always a balance between growth and what price we pay as an investor. So the choice of stocks in this product is always about looking at stocks which follow into a 6-pillar framework that we have in terms of stock selection, and at the same time make sure that there is a fair amount of margin of safety when we have additional exposure created in the stock. So to be very precise, I think this monthly rebalancing is something where the allocations move up and down, but within that the stocks will be having clear eyes on the valuations where they are at that point of time. And we also have a balancing between the large, mid and small caps using the benchmarks where it gives an indication of how large caps are trading vis-a-vis mid and small caps. So there is a part of the allocation decision which moves between large caps and mid caps depending on how the premiums or discounts behave between these two cap curves. This is again a function of how investors are exhibiting greed and fear at various cycles of market. So the positioning again over here for us would be more towards large cap when we see excesses building up in the mid cap, and vice versa during the other way around. As a product, we have the flexibility to move between 65 to 100% in large caps.
Okay.
Yeah, within the equity fund.
That's great. So how do you use derivatives in this fund then?
Yeah, so this product is a flexible product. Equities has the range of 30 to 90%, or even as high as 100% when we have, say, a COVID-like event. But since it comes under the tag of equity as a product, the investor is exposed to equity taxation. We need to be at gross equity of 65% any point of time.
Okay.
So while the model might throw up a 40% equity or a 30% equity, we use arbitrage as a category to get ourselves to 65%. For starters, arbitrage is fully hedged equity positions, where the returns typically mirror somewhere around the repo rates, which are indicative of the cost of carry. So from derivatives, I think the clear application is more towards arbitrage, and nifty derivatives are used at points of time where we believe we need to have some hedge against the underlying. So these are two areas where derivatives are used.
Okay.
The additional instruments outside derivatives, what we use are the new ones which have been listed as the REITs and InvITs as a category. It's an emerging area. We are still yet to see a large opening of instruments here, but from a investor perspective, it gives an exposure to the investor to a quasi debt-like instrument with a fixed annuity income coming out of it. So that would be the other area where we've been increasing exposure.
All right. So we talked about the fund, but why should this fund be a part of an investor's core portfolio?
Great question. So from an individual perspective, the normal questions which one grapple is with on the market is when to invest, how much to invest, and where to invest. So the first two questions get tackled by this product in terms of when to invest and how much to invest. And this is where the PE framework gives the scientific confidence on where the money is getting in terms of equities, at what point of time, and whether it's increasing or decreasing. And the stock selection part of it comes from the active fund management. So as Sundaram in the past, we've been proving ourselves in terms of stock selection across cap curves, and that comes in handy, especially at times when one looks at equities, but within equities one has to make the decision in terms of growth at reasonable price. So active fund management is more towards stock selection, whereas the product is more towards taking care of the market timing risk and the allocation risk as to how much we need to invest. The beauty of this product is that in volatile markets, it helps the investor cap his drawdown. So a classic example I can give you, over the last 7 months where we've seen valuations expand, there was always this feel that earnings need to catch up to the pace at which valuations were expanding. So it forced the product to have equity allocations around the 45% handle. And at times when market is starting to turn fearful, we are slowly nudging up equities. So it has the ability to book profits when we are seeing excesses happen in the market. And there is always this action which is again forcing us to get back into equities when valuations turn attractive. So the drawdown which an investor normally has in a down cycle or a consolidating phase is capped, apart from this tax efficiency which he has when he exposes himself to this product. So clearly, if an investor has to have a part of his portfolio towards asset allocation as a category, this is one product which fits into all the check boxes in terms of taking care of timing risk, stock selection risk, and in terms of having lower drawdowns during various market cycles.
Yeah, it's nice to check all those boxes because as an investor, that's what we want. Thank you so much, Bharath, for taking the time out to answer these questions. It's been a pleasure having you on the series.
Great, thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.